In today's video, the IRS has updated their website with how the One Big Beautiful Bill will affect working Americans and seniors. So make sure you stay tuned for all of the details. But before we begin, as always, welcome back, everyone. So very happy to have you back for another IRS update. This information is being shared from irs.gov. The One Big Beautiful Bill was signed into law on July 4th. Now let's go over deductions. Deductions reduce the amount of your taxable income. In general, individuals not in a trade or business or an activity for profit may take a standard deduction or itemize their deductions. The standard deduction is a flat amount based on your filing status: single, married filing separately, married filing jointly, head of household, or qualifying survivor spouse. Taxpayers age 65 and older and blind taxpayers may get an additional deduction. Under the new bill, no tax on tips. Effective for 2025 through 2028, employees and self-employed individuals may deduct qualified tips received in occupations that are listed by the IRS as customarily and regularly receiving tips on or before December 31st, 2024, and that are reported on Form W-2, Form 1099, or other specified statement furnished to the individual or reported directly by the individual on Form 4137. Employees use Form 4137 to report and pay their share of Social Security and Medicare taxes due on tips they did not report to their employer, and this includes any tips allocated to employees of large food and beverage establishments. Generally, employees must include the allocated tips as income on their income tax returns unless they have adequate records to show that they received less tips in the year than the allocated figures. Qualified tips are voluntary cash or charge tips received from customers or through tip sharing. Maximum annual deduction is $25,000 for self-employed. Deduction may not exceed an individual's net income without regard to this deduction from the trade or business in which the tips were earned. Deduction phases out for taxpayers with modified adjusted gross income over $150,000, $300,000 for joint filers. Now let's move on to taxpayer eligibility. The deduction is available for both itemizing and non-itemizing taxpayers. And for self-employed individuals in a specified service, trade, or business under Section 199A are not eligible. Employees whose employer is in an SSTB also are not eligible. SSTB is any trade or business providing services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investing and investment management, trading or dealing in securities, partnership interests, commodities, any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners, as demonstrated by receiving fees, compensation, or other income for endorsing products or services, licensing or receiving fees, compensation, or other income for the use of taxpayers' image, likeness, name, signature, voice, trademark, or any other symbols associated with the individual's identity, or receiving fees, compensation, or other income for appearing at an event or on radio, television, or another media form. And that is what qualifies as an SSTB, and they are not eligible for this deduction under the One Big Beautiful Bill. Taxpayers must include their Social Security number on the tax return and file jointly if married to claim this deduction. Reporting. Employers and other payers must file information returns with the IRS or furnish statements to taxpayers showing certain cash tips received and the occupation of the tip recipient. And by October 2nd, 2025, the IRS must publish a list of occupations that customarily and regularly receive tips on or before December 31st, 2024. So make sure to watch out for that. Make sure to check the IRS website as well as stay subscribed to this channel for all of the IRS updates and breaking news. The IRS will provide transition relief for tax year 2025 for taxpayers claiming the deduction and for employers and payers subject to the new reporting requirements. Now let's go over no tax on overtime. Effective for 2025 through 2028, individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate of pay, such as the half portion of time and a half, compensation that is required by the Fair Labor Standards Act, FSLA, and that is reported on a Form W-2, Form 1099, or other specified statement furnished to the individual. Maximum annual deduction is $12,500, $25,000 for joint filers, and deduction phases out for taxpayers with modified adjusted gross income over $150,000, $300,000 for joint filers. Taxpayer eligibility. The deduction is available for both itemized and non-itemized taxpayers. Taxpayers must include their Social Security number on their tax return and file jointly if married to claim this deduction. And as for reporting, employers and other payers are required to file information returns with the IRS and furnish statements to taxpayers showing the total amount of qualified overtime compensation paid during the year. The IRS will provide transition relief for tax year 2025 for taxpayers claiming the deduction and for employers and other payers subject to this new reporting requirement. No tax on car loan interest. Effective for 2025 through 2028, individuals may deduct interest paid on a loan used to purchase a qualified vehicle, provided the vehicle is purchased for personal use and meets other eligibility criteria. Lease payments do not qualify. Maximum annual deduction is $10,000. The deduction phases out for taxpayers with modified adjusted gross income over $100,000, $200,000 for joint filers. Qualified interest. To qualify for the deduction, the interest must be paid on a loan that has originated after December 31st, 2024 and used to purchase a vehicle, the original use of which starts with the taxpayer. Used vehicles do not qualify, and the vehicle must be for personal use, not for business or commercial use, and secured by a lien on the vehicle. If a qualifying vehicle is later refinanced, interest paid on the refinance amount is generally eligible for the deduction. Qualified vehicle. A qualified vehicle is a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds and that has undergone final assembly in the United States. Final assembly in the United States. The location of final assembly will be listed on the vehicle information label attached to each vehicle on a dealer's premises. Taxpayers may rely on the vehicle's plant of manufacturer as reported in the vehicle identification number to determine whether a vehicle has undergone final assembly in the United States. Also, the VIN decoder website for the National Highway Traffic Safety Administration provides plant of manufacturer information. Taxpayers can follow the instructions on that website to determine if the vehicle's plant of manufacturer was located in the United States. Taxpayer eligibility. Deduction is available for both itemizing and non-itemizing taxpayers. The taxpayer must include the vehicle information number of the qualified vehicle on the tax return for any year in which the deduction is claimed. In terms of reporting, lenders or other recipients of qualified interest must file information returns with the IRS and furnish statements to taxpayers showing the total amount of interest received during the taxable year. Guidance: the IRS will provide transition relief for tax year 2025 for interest recipients subject to the new reporting requirements. Deduction for seniors, effective for 2025 through 2028. Individuals who are age 65 and older may claim an additional deduction of $6,000. This new deduction is in addition to the current additional standard deduction for seniors under existing law. The $6,000 senior deduction is per eligible individual. For example, $12,000 total for a married couple where both spouses qualify. Deduction phases out for taxpayers with modified adjusted gross income over $75,000, $150,000 for joint filers. Qualifying taxpayers. To qualify for the additional deduction, a taxpayer must attain age 65 on or before the last day of the taxable year. Taxpayer eligibility. Deduction is available for both itemizing and non-itemizing taxpayers, and taxpayers must include the Social Security number of the qualifying individual on the tax return and file jointly if married to claim this deduction. And that brings us to the end of this video. These are the beautiful parts of the big beautiful bill. Make sure to share with us in the comments how you are feeling about these new deductions for Americans and seniors. And don't forget to subscribe, hit that notification bell, and come back for more IRS updates and breaking news. Bye-bye.